Check out shares of Quicken Loans parent Rocket Companies. That stock up big this morning, and it is climbing even as we speak. It was up 10% when we went to the commercial break. Now it's up 12.5%. These are pretty significant moves. It comes as Rocket reports a nearly 150% increase in revenue for the fourth quarter, thanks to a boom in mortgage activity. Joining us right now to talk about the results and the impact of rising interest rates on housing is Rocket Company CEO Jay Farner. Jay, I want to run through some of these numbers because these numbers are incredibly impressive. For the full year, for 2020, you saw a record loan volume of $320 billion. You saw revenue more than triple to $15.7 billion. And then net income came in to $9.4 billion. And that's from under $1 billion a year ago. For the fourth quarter, very similar sort of trends here. Revenue, $4.7 billion, up from $1.9 billion. And net income was $2.8 billion, up from $0.8 billion a year ago. So those are big, big numbers. What's happening? What's driving that? Is it refinancing? Is it new mortgage originations? What are you seeing?
Well, thank you, Becky, and thanks for having me here this morning, and thanks for reporting all of that good news. You know, when you're building out a platform company the way that we are at Rocket Companies, you've got to be able to do two things. You've got to have scale, and you've got to be able to scale quickly, and you've got to have operational efficiency. And so that's what we've been focusing on and investing in for years and years, and I think 2020 demonstrated our ability to do that, growing, I think, about $175 billion, or adding that to our platform from a mortgage perspective, which is equal to or maybe even greater than the total production our competitor, our second largest competitor, was able to do. But the other piece is efficiency. And as we get into the changing markets, you guys have been talking all day about the 10-year rising and mortgage rates ticking up. Well, that efficiency to produce an item at a lower cost than others allows us to continue to grow while we see pressure on the broader market. And so those are the two things that we've been focused on.
You know, I can understand the efficiency arguments. I have refinanced loans with you guys, and I have to say, you do have the technology. You keep it in there. But the moves that we're seeing right now, I think, come in part because you've got a stock that's heavily shorted. We're not talking Reddit. This has not been one of the GameStop-type stocks where you see some big moves. But last I saw, I think the short interest was about 40% for Rocket Companies. I know there was some unusual options activity yesterday in the stock with the expiration of some of the options that were out there. And now just looking at the stock up 14%. I mean, this is a fast mover. First of all, what would you say to the short sellers, Jay?
Well, I'm going to say the same thing that I've been saying for quite some time now. We've been doing this for 35 years. We're building out a great platform, a platform that captures the lifetime value of the clients that we interact with. Yes, mortgage is awesome. We love the refinance business that we do. We love the purchase business that we do. But our Rocket Homes platform, $6 billion in real estate transactions last year. That'll double this year. Our Rocket Auto platform, $750 million in GMV. That will double this year. And so when we're thinking about acquiring a client, we're thinking about the lifetime value of that client. And I think that makes us very different than some of the traditional competitors that investors think of us or compare us to. And so, you know, over time, Becky, this will play out. You know that Dan and I have been doing, well, I've been here for a quarter of a century, so we're kind of long haul guys. We think about the right investments, technology, our Rocket Cloud Force, our brand, our data lake, all of those things. That's the type of mindset that we have, and I think over time that'll play out, and you'll probably see fewer and fewer people shorting the stock.
You know, Jay, part of the thesis for the short sellers has to be that interest rates are rising. And historically, your company has always done very well when there have been refinance booms. That happens when interest rates are low. We've been talking all morning about how the stock market has been thrown a little bit by the idea that we actually moved on the 10-year to 1.5% last year, or yesterday, I should say, when that was what people were anticipating for the end of the year. Seeing quick moves like that, does that show up in your business?
You know, we've been... You know this better than anybody. When the bond market moves, it tends to move quickly, especially after coming down the way it did in 2020. So we don't focus on that, and our ability, again, to be very efficient, these types of moves really create opportunity for us. So as our competitors who've joined the marketplace look and try to figure out how do they stay profitable in markets like this, we are able to lean in. You'll probably see our marketing budget, in particular our performance marketing budget, move up this year as we see opportunity to grab market share. And as I referenced, it's also about the broader platform. So not the first, second, or third time I've seen interest rates move up. We'll see them move down as well. And that's another thing that we always look for. As one of the largest servicers in the country, we've got almost 2.2 million people in our servicing book right now. As we acquire those clients at higher interest rates, we are kind of reloading the pipeline for days when rates will drop, and then our retention rate, nearly 90%, will bring those clients back again. So these cycles go up, they go down, but from a long-term perspective, all of these things, when done properly, will benefit our company.
You mentioned your marketing budget. I always think of you guys being a very big advertiser. How much did you spend on advertising last year? How much do you plan to spend this year?
Yeah, we did close to $1 billion last year. So our two Super Bowl spots, which I think were rated #1 and #2 at the USA ad meter. So that was incredible. And our CMO is always excited about spending money on those things. But behind the scenes, we're also spending on performance marketing, digital marketing. And so that's really where you'll probably see an increase. I wouldn't be surprised if we go north of $1 billion a year in marketing, but that dollar spent is equaling $3, $4 back in revenue on our platform. And as Dan Gilbert always reminds me, if you look back in 2020, 70, 80 cents of each one of those revenue dollars is dropping to the bottom line.
You know, that's always been the big question with advertising. You know it's working, but you don't know which dollars are. Is that different? You know, that's the old kick on advertising. Do you know exactly which dollars are working, especially if you're doing that with digital advertising?
Yeah, the visibility that we have into those dollars, not only with the direct-to-consumer, right, and tracking all of that, but think about the partnerships now that we're able to do. We announced E-Trade yesterday, Morgan Stanley, Charles Schwab, Intuit, all of those things we can invest our marketing dollars in, and those are very, very trackable. So that's what gives us that confidence to invest hundreds of millions of additional dollars as we go into 2021.
Shepard Smith here. Thanks for watching CNBC on YouTube.